Hey, I'm Monty. Before we dive in, I want to be straight with you. I'm not a financial advisor, and I'm not here to sell you a dream. What I do is take real data, run the numbers, and break it down in plain English so you can make your own call. Every stat I use will have a source on screen. Every strategy I share is one I've actually researched. No hype, no shortcuts, just the information you need to move forward. That's Monty's promise. Let's get into it. A 500 credit score. Most people treat it like a life sentence, like it's permanent and there's nothing you can do. But here's what I found when I actually went through the research. A 500 score is not a wall, it's a starting point. And the path out is more specific and faster than most people realize. I went through the data, mapped the 5 factors that control your score, and built a system that works even from 500. Today, I'm giving you the complete roadmap. No fluff, no credit repair scams, no impossible advice. Just the exact sequence of moves that the scoring model actually responds to. Let me make this real with numbers. If you finance a $25,000 car today with a 500 score, you're likely looking at an interest rate between 12 and 18%. Someone with a 720 score gets that same car at 5 to 7%. On a 5-year loan, that difference is roughly $5,000 to $8,000 in extra interest. That's a real number you pay out of your own pocket for the same car. On a mortgage, the gap is even wider. A $200,000 home loan at 8% versus 6.5% cost you an additional $68,000 over 30 years. That's not a rounding error. That's the price of a low credit score paid in installments over years on every financial product you ever touch. Raising your score from 500 to 650 doesn't just feel better, it has a real, calculable dollar value.
Almost every credit score sitting at 500 traces back to one or more of 3 causes. Cause 1, missed payments. A single payment 30 days late can drop a score by 60 to 110 points. Multiple late payments stack that damage fast. Cause 2, high credit utilization. Using 70, 80, or 90% of your available credit signals to the scoring model that you're financially overextended, and it hammers the score accordingly. Cause 3, a collection account or charge-off on your report. An old medical bill, a utility account, a credit card that went to collections. Any of these showing as active can anchor a score in the 500 range almost indefinitely until addressed. Here's why identifying your cause matters. The strategy differs. High utilization can move fast, sometimes within one billing cycle. Late payment history moves slower. Collections require a different negotiation approach entirely. Know your cause. Then apply the right move first. Your FICO score, used by 90% of top lenders, is calculated from 5 factors with specific percentage weights. Payment history is 35%. Amounts owed, including your credit utilization, is 30%. Length of credit history is 15%. Credit mix is 10%. And new credit inquiries is 10%. 2 factors. Payment history and utilization control 65% of your entire score. That's the number that changes everything. If you are at 500 and you fix your utilization and clean up your payment history going forward, you will see movement. The other 3 factors matter for the long game, building account age and credit mix over time. But in the recovery window, the 90 days we're focused on today, every move targets those top 2 factors specifically. Every single one. Payment history is 35% of your score, the most important single factor. Here's the honest picture for someone at 500. A late payment stays on your credit report for up to 7 years. You can't make it disappear immediately, unless it's an error, which we'll cover in Move 2. What you can control is this. The model weights recency heavily. A late payment from 3 years ago hurts you significantly less than one from 3 months ago. So the strategy is twofold. First, stop adding any new late marks starting today. Second, let the old ones age. Every month that passes without a new late payment, the old damage fades slightly. The immediate action: set every credit account to auto-pay the minimum payment due from your checking account on the due date. Not the full balance, just the minimum. This removes human error from the equation entirely. Every on-time payment from this moment forward is a brick in the wall you're building. Credit utilization is 30% of your score and the fastest moving lever available to you. If you have a $2,000 credit limit and a $1,600 balance, your utilization is 80%. That's doing serious damage. The standard advice says, stay below 30%. But here's what 800-plus scorers actually do. Their average utilization is under 6%. The target for recovery is 1 to 10%. Now the timing trick almost nobody covers. Your balance gets reported to the credit bureaus on your statement closing date, not your payment due date. Those are two different dates. If you pay down your balance before the statement closes, the bureau sees a low number. If you wait until the due date, they already logged last month's high balance. Pay before statement close, not before due date. Statement close. Check your card's statement closing date in your online account settings right now. This one timing change alone can move your score within a single billing cycle. Here are the 5 moves that have the highest and most consistent impact when you're recovering from a 500 score. Move 1. Lower your credit utilization below 10% before your next statement closing date. Move 2. Pull your credit reports from all 3 bureaus and dispute every single error you find.
Become an authorized user on a trusted person's account. Open one secured credit card to start building positive account history. Automate every minimum payment on every account, starting today. I'm walking through each move right now with the exact action, a realistic timeline, and what drives the result. Pay close attention to Move 2, because 1 in 3 Americans has at least one error on their report that's costing them points they don't know about. Open every credit card account you have. Write down each card's balance and its credit limit. Divide balance by limit. That's your utilization per card. Then add up all balances and all limits for your overall utilization. 2 things matter: per card utilization and overall utilization. One maxed out card hurts your score even if your overall number looks okay. Prioritize getting every card below 30% first, then push toward 10% or lower. 2 accelerators if cash flow is tight. First, call your card issuer and request a credit limit increase with no hard inquiry. Ask specifically, can I get a limit increase without a hard pull? A higher limit with the same balance automatically lowers your ratio. Second, redistribute balances across cards so no single card is above 30%. Then pay down before your statement closing date, not your due date. Check the statement closing date in your account settings right now. Pull your free credit reports and dispute every error you find. You're legally entitled to a free report from all 3 bureaus, Equifax, Experian, and TransUnion, through annualcreditreport.com.
That is the official government-authorized site. Say it carefully when you type it. There are lookalike scam sites. Pull all 3 reports separately because an error often shows on one bureau but not the others. Review each report for accounts you don't recognize, payments listed as late that you made on time, incorrect balances, collection accounts that are already resolved, or duplicate entries. A 2021 Consumer Reports investigation found that 34% of Americans have at least one error on their credit report, 1 in 3. Dispute errors directly with the Bureau online. It's free, it's your legal right, and the Bureau has 30 days to investigate. If they can't verify the information, it must be removed. A single removed error, especially a false collection or late payment, can move a 500 score by 40 to 80 points almost immediately. Move 3. Ask a trusted family member to add you as an authorized user on their credit card account. Here's the mechanic. When you're added as an authorized user, that entire account history, their payment record, their utilization, their account age, gets added to your credit report. If the primary cardholder has years of on-time payments and low utilization, those positive signals now appear in your profile. You don't need to use the card. You don't need the physical card in your hands. Just being listed as an authorized user is enough for the history to transfer to your report. For someone at 500 with limited positive account history, this is one of the fastest ways to add aged, clean credit history to a damaged file.
Studies show 20 to 50-point improvements within 1 to 2 billing cycles for people with thin or poor credit files. Critical check before asking. Make sure they have consistent on-time payments and utilization below 30%. You inherit their habits on that account, good or bad. Move 4. Open a secured credit card. If you're at 500 with limited positive account history, a secured card is the most direct tool for building the foundation. Here's how it works. You deposit between $200 and $500 as collateral. That deposit becomes your credit limit. You use the card for small, planned purchases. You pay the full balance before the statement closing date every single month. The card issuer reports your payment activity to all 3 credit bureaus, exactly like a regular credit card. You're simultaneously building payment history, adding a positive account to your report, and keeping utilization low. 3 things to look for when choosing a secured card. Number 1, no annual fee. Number 2, reports to all 3 bureaus, not just one. Number 3, has a clear upgrade path to an unsecured card after 6 to 12 months of on-time payments. And this is important. Your deposit is not a fee. You get every dollar of it back when you close or upgrade the account. This card is your recovery foundation. Move 5. Automate every minimum payment on every account, no exceptions. Here's the exact setup. Log into each credit card, loan, and any credit account you carry a balance on. Go to autopay settings. Set autopay to pay the minimum payment due from your checking account on the due date. This is your floor. It guarantees no new late marks ever appear on your report again. Then separately, you manually pay the full balance before the statement closing date when cash flow allows. The combination means 0 late marks ever, low utilization when you pay the full balance early, and 0 interest charges. 3 mistakes I see consistently when people try to climb out of a 500 score. Mistake 1. Applying for multiple credit cards at once, hoping one approves you. Every application triggers a hard inquiry that drops your score 5 to 10 points. Mistake 2. Closing old accounts to start fresh. Mistake 3. And this one surprises people. Paying off a collection account and assuming your score will jump immediately. Before paying any collection, ask for a pay-for-delete agreement in writing. Here's the realistic recovery timeline when you apply all 5 moves consistently, starting from 500. Days 1 to 7. Pull all 3 credit reports. File disputes on every error. Set autopay on every account. Lower every card below 30% utilization before your next statement closes. Days 8 to 30. First billing cycle with no new late marks. Days 30 to 60. Second clean billing cycle. Days 60 to 90. Third consecutive month of on-time payments. Low utilization. Resolved disputes. Moving from 500 to 580 to 620 is realistic. 500 to 650 is achievable for people who remove errors and fix utilization simultaneously. Here's your summary. 5 factors build your score. 2 control, 65% of it. Payment history and utilization. 5 moves to execute in order. 1. Lower every card below 10% utilization. 2. Pull all 3 reports and dispute every error. 3. Set autopay. 4. Become an authorized user. 5. Open one secured credit card. Go to annualcreditreport.com. Pull all 3 reports. Just that. What you find will tell you the fastest path forward.